US consumer confidence is weaker than expected, locking in expectations for a Fed rate cut this week. India's inflation is benign, and New Zealand's manufacturing sector contracts. But retail sales rise. That's coming up in our 5 Things in 5 Minutes on Monday, September the 15th. And then in our deep dive interview, ANZ Group Chief Economist Richard Yetsenga summarises the likely fallout from Donald Trump's tariffs.
It's the US tariffing the world in large part, not the world tariffing each other. What we're likely to see in large part is demand and production be reallocated, be shifted around rather than demand fall away.
But first, in 5 and 5 with ANZ, US consumer confidence fell more than expected this month, says ANZ economist Bansi Madhavani.
Consumers are more concerned about their employment prospects, which weighed on the outlook. At the same time, there are also concerns about persistence of inflation. So broadly, consumers are now thinking about their employment prospects and their personal finances. Look, such an outlook is not surprising given that the labour market has weakened meaningfully in the last few months.
The S&P 500 closed flat on Saturday morning, Australian time, and the Nasdaq rose another 0.4% to another record high, thanks to rises for Microsoft and Tesla shares. The yield on the US 10-year Treasury rose 5 basis points to 4.06%. Gold closed up 0.4% at $3,686 an ounce, albeit below a new intraday record high of $3,695. West Texas oil futures rose 0.5% to $62.69 US a barrel. The US dollar index was flat, but the Aussie dollar fell 0.1% to 66.50 US cents. And the Kiwi fell 0.3% to 59.56 US cents. Number 2. Bansi says the weak US consumer confidence is important for the Fed's decision due early Thursday morning, Australian time.
We think the data are another affirmation that the Fed is set to resume its rate cutting cycle this week, kicking off with a 25 basis point rate cut.
Number 3. Over the weekend, we got inflation data from India, where the annual CPI inflation rate was 2.1% in August, up from an 8-year low of 1.6% in July. And that was thanks to higher prices for eggs, meat, fish and oils. ANZ economist Dheeraj Nim says core inflation outside of those areas is well behaved. And so far in the September quarter, inflation is tracking below the Reserve Bank of India's estimates.
We think that the current run rate being softer than their projections and also some inflationary impact of the recently announced GST rate cuts would mean that inflation would remain below the RBI's projections and prompt at least another 25 basis point in rate cut in Q4 2025.
Number 4. In New Zealand on Friday, we got the Survey of Manufacturers data for August, which found the sector slipped back into contraction. But ANZ senior economist Matt Galt saw some good news on closer inspection.
Underneath the hood, there were some interesting details. Actual production this month was quite weak, but new orders was quite strong. So that suggests that the gradual recovery we're seeing from the mid-year slump is still on its way, and things should gradually continue to improve from here.
Number 5, also from New Zealand, retail sales via electronic transactions rose 0.4% in August from July. I asked Matt what both sets of figures say about the New Zealand economy midway through the September quarter.
The economy definitely looks to have started on a better footing in Q3 compared to Q2, where we expect the economy went backwards in Q2. But the indicators are still mixed, which is what you expect around turning points, where older indicators are weaker and things still are fairly patchy. We think a gradual recovery is still on its way, with lower interest rates and high farm incomes being 2 key factors behind that.
Matt Galt there. Now, in our deep dive interview, I spoke to ANZ Group Chief Economist Richard Yetsenga on the fringes of the AFR Asia Summit in Sydney. That's why there's a bit of noise, which ANZ sponsored. Donald Trump's tariffs were the top items of discussion at the conference, and one theme that emerged was that Asia's economies had coped relatively well so far. I asked Richard why the fallout had been so limited.
Asia has been more resilient, not just China, but in fact other parts of the region. I think a few reasons for that. One is part of it is a bit of fortuitous timing because of the uncertainty about where the tariffs would eventually settle, these negotiation periods, the US administration rolling deadlines forward. There was kind of bring forward. So part of this is there's probably a little bit of wily coyote and there's a bit of payback to come now that the tariffs are cemented in large part and started to be operational. There's also some pretty fundamental things, though. It's the US tariffing the world in large part, not the world tariffing each other. And what that is likely to mean is it's a very different outcome than if everybody was tariffing everybody else. What we're likely to see in large part is demand and production be reallocated, be shifted around rather than demand fall away. So there's some challenges for Asia, but kind of sand in the wheels of trade rather than a trade recession. The dollar also has been a bit on the nose this year, the US dollar. So Asian currencies have held up pretty well. That's provided room for some of the Asian central banks to cut rates. Indonesia is a good case in point. Unstable global period. Typically, Indonesia wouldn't be able to ease. It's been able to do so this time. So a little bit of kind of don't be too impatient about the Asia story. There's probably a bit of discomfort to come, but actually some pretty strong reasons for why this is going to be a cyclical adjustment rather than something nastier.
There's some signs now of demand in the United States and jobs starting to be slower. It has been the world's engine room of consumption and imports. How does Asia cope in a world where maybe that engine room is not as hot as it has been?
The US is about a quarter of world demand. It is the global consumption story. So what happens to US consumption is going to impact the world. There have been lots of periods we look back on and say, how did economists get it so wrong? I mean, maybe on 2025, when we look at the US, we'll say, how did economists get it so right? Tariffs are going to be a cost to the American economy. Being indiscriminate about, in large part, about the way you deal with views about migration is going to impact the supply of labour in the economy. Kind of a chaotic approach to policy, which makes it difficult for businesses to plan. It's going to affect investment. All of those three things are likely to result in a slowdown in the US economy until you see some adjustment in those policies. I think as we head into the closing stages of 2025, that's exactly what we're seeing.
There's also been some discussion about how Australia itself responds if there is going to be, a slowdown in trade, particularly between China and the United States, and it may need to diversify a bit more. What's your view on its ability or opportunities to diversify and cushion any blow by selling elsewhere?
There's two levels to look at that. At a micro company specific level, diversification is often difficult. So there's no doubt that there will be some discomfort, some cost for some companies in certain sectors. Australia has this macroeconomic advantage though, because a lot of what comprises the bulk of Australia's exports, large kind of uniformly priced commodities which can be shifted around the world. So as long as there's demand in the world for a gold and iron ore and even coal these days, agricultural products and some even tourism and education, we can see some adjustment. And that may well be costly. It may well take some time. It may well cost margin. Highly unlikely that's the sort of adjustment, though, which causes the economy serious macroeconomic problems.
And just to flip on its head, is there some parts of this story that could benefit Australia? The minister talked about rising beef exports to the United States and to China, and that also some others have talked about Australia as a beneficiary for central banks and others looking to diversify their assets into not quite the reserve currency, but one of the other reserve type assets.
I think you're right to talk about both those avenues. And in fact, if you think about the political economy of all of this, as the US effectively is putting a tariff wedge between its own economy and the world, actually most of the rest of the world is trying to get closer together. Australia, the UK, Australia, Japan, Australia, Korea, Australia, Europe, UK, in an effort to kind of adjust to this shift by the US. And also this capital flow story is very important. About half of the Australian super fund industry invested offshore, about $2 trillion in very round numbers terms. Non-Japan Asia's asset holdings in the US are nearly $5 trillion. I think you are likely to see some adjustment in those asset pools over the next few years as kind of we adjust to a US economy which is likely to be more slowly growing, is likely to continue to operate in a way which is a bit separate from the, liberal economic order, and also where asset returns perhaps are perceived to be just a bit less safe and a bit less secure.
Richard Yetsenga there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, September the 15th. Catch you tomorrow with a look ahead to New Zealand GDP data due on Thursday. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.